All right, we're live, we're going, we're rocking, we're rolling. It's 4:30. It's time for the live stream Be the Boss of Your Money. It's a show all about helping you know and understand certain things about the market, what you need to know about investing, personal finance, borrowing, etc., so that you could make the best possible financial decisions for yourself and for your family. That's what the show is all about. It's about taking control of your money. Maybe we should have called the show Money Control, like Mission Control, but I just called it Be the Boss of Your Money because I couldn't think of anything better than that, as hokey as that is. Hokey, hokey. So, yeah, this is the market that everybody hates. I mean, nobody wants to be in this market. It just seems like everybody is so upset with the market. I understand there's a negative pull because we can't talk about the negative pull around, around us, without talking about the war in Ukraine. And I don't know if you've actually seen some of the horrendous pictures that people are saying that Anthony Blinken saw. He got all choked up with. I saw these pictures and they're pretty effing horrendous. And this is the stuff that, I mean, this is true like horror picture stuff, but it's real. It's reality. Like if you saw pictures that I saw of the mass graves and things like that. It's not like the stuff that they're showing you on NBC News or CBS News. I'm talking the real graphic stuff that a lot of American media outlets are not showing. But we're talking about the market and stocks, and I know it's kind of tough to talk about money and things like that. My screen is blinking like crazy. It's tough to talk about money at a time like this, but that is what the show is about. It's about you making smart moves with your money that are best for you. So we're going to talk about what's the deal with this market. Everybody hates it. What should you do about it? My answer is probably going to surprise you, and let's get on with the whole thing. If you have any comments, or I should say, in the comments, gee whiz, I always mess that up. In the comments, if you have any questions, ask me. Words of wisdom, words of appreciation. Those are always fun, and I love to see you. I know Jerry is out there. Thank you very much for joining me. And I love to hear from you. That's what makes it fun. So questions, insults. What's your point of view on this? Want to, don't worry about challenging me. Like, yeah, I could take it. Listen, hit me up. You disagree with me? Uh, I'd love to. I'd love that. I like the conversation that we could have. So let's roll a quick intro, and we will get into this market. What's so bad? What's so good? And why does it keep going up in spite of everybody just hating on it? Here we go. All right, let's just pick up where we left off last week. Friday morning, claims came out. There were about 430,000 jobs created. Expectations were 490. A slight miss, but nobody, the interpretation is that it was a very strong jobs market, and the months before, which were incredibly strong, were actually revised even higher. And a lot of people thought there would be downward revisions because usually when you get like a really big up month or a big down month for non-farm payrolls, usually you find that revisions dismantle those a little bit. But no, we actually got an even higher revision. So the economy is doing pretty good. Wages don't seem to be wages don't seem to be flying up as high as they were. In fact, wage growth seems to have slowed down quite a bit. Uh, Oil is up a little bit. Nothing huge. We thought we'd see, 150, $200 per barrel of oil. We never even came close. We did bounce up to 130 a couple of times, but never closed there. And we are currently at 103, $104 the barrel for oil. Everybody hates this market. We have a war. We have a hawkish Federal Reserve. Do you know what that means, by the way, when you hear the pundits say a hawkish Federal Reserve? Hawkish means that the Federal Reserve is very weary of inflation and they want to tighten monetary policy and slow down the economy. And when the Federal Reserve is hawkish, it has a few tools, but its main tool is controlling short term interest rates. So the Fed could raise short term interest rates like the federal funds rate and the discount rate. And when it does that, it has the chilling effect of slowing down credit growth in the economy because it makes it makes the cost of debt a little bit more expensive. And the higher the interest rate, the more the debt cost, the more your interest payments are, the less you are capable of borrowing. Maybe the less you want to borrow. Okay, so that's one thing about the hawkish. But the other thing is the Fed does something called quantitative easing. And in quantitative easing, the Fed buys bonds, lowers interest rates, and then quantitative tightening is the opposite when the Fed says, hey, we've got almost $9 trillion fact on the balance sheet, and we need to start getting rid of some of this debt, trillions of it actually. And when you do that, you push bonds into the market, bond prices go down, yields go up. And that's how you could see long term rates skyrocket. And that's how you could see like the 30-year mortgage rate surpass 5%. It's about in the four sixes, I believe, by the end of today when everybody thought it would be over five by now. Um, don't worry, we'll probably get there in short order. It's just not going to be in a straight line. All right, so that's we have that. We have obviously the war in Ukraine. We have a supply side shock. We can't get enough cars. We can't get enough auto parts. We can't get enough semiconductors. We can't get the materials that you use to make semiconductors, like neon. I think the biggest source of neon is it's an element. The biggest source of that is Ukraine. We can't get enough wheat because Ukraine is one of the biggest wheat suppliers in the world. Not as big as the United States, but a big one, and now their exports have of wheat have plunged. That affects the entire world, and these commodities trade on a global basis. That's why if there's a problem with oil in Eastern Europe, it affects the price of gas at the pump for you if you're driving through Pennsylvania or New York or Oregon or wherever you are in the United States. Oh yeah, so we have just and everything is connected, and so a lot of bad things. So and Fed's raising rates. That's what I mean by it's hawkish. Uh, War. I don't know. There were other things we were worried about. Earnings have peaked. Economic growth could slow, and then throw on top of that the inverted yield curve. And we've been talking about an inverted yield curve for so long. It's finally here, and that's when short-term interest rates are higher than long-term interest. It's usually like if you buy a bond for 90 days, it has a very low interest rate. And if you buy a bond that matures, let's say in 10 years, it have a higher interest rate. But flip them around because the Fed's raising rates. So investors don't want to own short-term bonds. Why would they want to own short-term bonds when they could wait and buy new short-term bonds with a higher yield because the Fed's raising yields, raising interest rates? And since people think that that could slow down the economy and people want a place to put their money into, they buy longer dated treasuries like 10-year treasuries. So 10-year treasuries, even though the 10-year yield is up a lot this year, uh, it's kind of getting stuck at around 2.4, 2.5 is where the ceiling seems to be at the moment. That could change, but at the moment. And then you have the 2-year going a little bit above 2.4%. We're going to take a look at these yields in a moment. So uh, when that happens, that portends or predicts that a recession is coming in the next, let's say, 12 to 18 months. It's not a perfect forecaster, but it's damn close. I think in the last like 15 times you had an inverted yield curve where short-term rates went above long-term rates. Only one time was it a false positive. So it's a pretty darn reliable indicator that bad stuff is happening to the economy. Now, when I say that, it doesn't mean that it's a crushing blow of a recession. Uh, 2007 to 2009, for anyone who is, under 90 years old, that's the worst recession that we've had since the Great Depression. And it was a really serious recession. Luckily, the Fed had all kinds of programs and um, things that it could do in order to help the economy and in order to save us from standing on bread lines and to prevent panic in the banking sector. And ultimately, everybody was able to get what they needed. If you needed food, you got it. You needed your health care, you got it. You needed gasoline, you got it. I think the thing that was really tough to come by was a job. And if you were in the mortgage industry or in real estate, that was probably the toughest place to find a job. But ultimately, we recovered. We recovered better than ever. Real estate soared. The price of houses continue to make new highs. Commercial real estate, if you're in industrial and warehouse space, if you're in that industry, you're doing pretty good. If you're in commercial, office space, you're probably still suffering a bit. Anyway, the Fed raises rates, slows down the economy too much. We go into a recession. If the Fed could slow the economy a little bit to tamp down inflation without going into a recession, that's called the soft landing. It happened in the mid '80s, and it happened in the mid '90s, where the Fed raised rates. I still have this cough. I'm sorry. It's believe it or not, it's much better now than it was like a week ago. Sorry, it's just killing me. So anyway, I feel better, don't you? So it's happened before where we've engineered a soft landing. Brother Tom, I see you out there as well. Thanks for the like. Guys, while you're watching this, give the show a thumbs up or a heart or the applause reaction or the wow reaction, depending on which platform you're watching from. And that always helps me get the show out to more people. And it also lets me know who's watching. And if you have any words of wisdom, words of encouragement, or if you want to share your own point of view about what we're talking about, that's what the comments are for. Certainly, if you have any questions, definitely hit me up there as well. That's the best part when you ask me questions or hit me up with your point of view, especially when it's different than mine, because then it gives us something to really talk about. So everybody hates this market. The economy is going to hell in a handbasket. We're hitting a horrible recession, is how everybody feels. But how people feel is a little different than what actually happens. I don't like to go by feel. I look at a number of inflation indicators like the 5-year Treasury, the 5-year inflation expectations, and they're not really that high. It seems like investors are pretty confident that inflation will come down before the next couple of years. And when you see a 10-year Treasury yield that is a little bit below short-term yields, like 1-year or 2-year Treasury bills, you have to also realize that the Federal Reserve has purchased trillions of dollars of long-dated treasuries, and that could be, wreaking havoc a little bit on the yield curve as well. Yeah, I hate to say this time is different. It's a very dangerous thing to say because patterns do repeat themselves. But we've never had anything like this where the Federal Reserve has bought so many bonds and Congress has stimulated the economy the way it has, with trillions of dollars of spending to get through the pandemic. So we've never had a time like this. So is this time different? Well, if we've never had a time like this, All right, I'm back. I hope some of you guys stuck around. I'm really sorry about that. This has happened a couple of times. I'm gonna may have to switch my provider, but I use Optimum, and we all have our opinions about Optimum. None of them are good. Okay, so things really are different this time. Let's take a look at how things did in stock market world. Okay, so you see here Dow up 100 points, Nasdaq up a big day, up almost 2%, S&P up 0.8%, pretty good day there. Gold up a little, oil was up a little, nice rebound from last week. 10-year yield at 2.39, didn't quite, it hit 2.4 earlier in the day, but the VIX, I'm not really so interested in the euro dollar right now, but the VIX below 19. It goes below, stays below 20, we rally, and that's continued to be the case for now. And the Russell 2000 index, this is the index of small cap stocks, was up slightly as well. But by and large, most things were up today. And we're back. Okay, this is, oh man, I hate that. Anyway, let's keep going. Let's take a look at bonds. Um, the 2-year at 2.42%. You see that? 2.42, and the 10-year at only 2.39. So it's inverted, and yields continue to go down for the day and 2 point there for a little bit. We expect the 2-year to keep going higher as the Fed raises interest rates, and we expect the 10-year to eventually start to move higher also as the Fed lets bonds roll off its balance sheet. What that means is this: with $9 trillion of bonds on the balance sheet, as these bonds mature, the Fed gets cash back. But what the Fed sometimes does is they, as bonds mature, let's say $1 billion worth of bonds mature from the Fed's balance sheet, the Fed would just buy back another $1 billion worth of bonds to replace those bonds. If they let them roll off, then they just don't replace the bonds, and the Fed's balance sheet in this example would shrink by $1 billion. Okay, let's keep going. Stocks. We looked at stocks. U.S. market news, and let's take a look at the watch list over here. Communications, that's predominantly Facebook and Netflix, which both had a good day. Uh, Discretionary, technology, energy, building materials, but industrials, real estate down, financials down, utilities down, healthcare down. But technology had a really good day. And I just want to point this out because there seems to be, not seems, there is a resurgence taking place in the meme stocks and the Corona list. Okay, stocks that benefited from work from home. If you look, okay, Moderna. Well, Moderna has been climbing a little bit, even though it was off today. Campbell Soup was off a drop, big deal. Activision, don't go by Activision because they're being acquired for about $80 by Microsoft, so it's just been trading at around $80. But Disney was up, Clorox is up, Domino's is up, Teladoc is up, DocuSign, nice recovery off the bottom, still way off its high. DoorDash up, Zoom up, Peloton even, okay, Roku, others as well. So there's been a resurgence in those particular stocks. So let's take a look at the meme stocks, aptly called the meme stock list, okay? And meme stocks have been surging as well. AMC only up a penny. I wouldn't call that a surge, but up a lot from its bottom. Um, GameStop was recently 80, and now it's 170. So that stock has had a double in a pretty short amount of time. Bed Bath, cost. That's had to move up. Clover has had a little bit of a move up. Wendy's, Hood, it's a nice move up from under $10. Okay, so but meme stocks have been seeing a little bit of a resurgence also. So it seems to me that people have regained their desire to own some of the more speculative parts of the market. I was at a meeting on Friday. This past Friday, I spoke, And I talked about two things. I talked about um, global finance, okay, in particular, global connectedness, and how that's on the wane. How we were so connected to other countries because companies were manufacturing stuff where they could get the best bang for the buck. So globalization. If it was cheaper for Ford Motor and GM to, manufacture headlights or have them manufactured overseas, they would do that. And so now companies are sourcing parts from the lowest cost manufacturer for the best quality all over the country. That's globalization. It brings down inflation. Yes, it hurts wages, but overall the economy has grown. And overall, I would say that the standard of living in the United States has been, by and large, pretty good. Okay. Who dare calls me during a live stream? So funny. I was just complaining to you how I can't stand Optimum and how they keep dropping my internet like this. And Optimum is actually calling me now on a cold call to probably try to upsell me on some service that I never asked for. And it's the same person who calls me like every single day. It's like pathetic. It's like really like what a loser. Every day call me for the same thing. If I was interested, I would call you back, right? Anyway, yeah. So let's just go on from here. And yeah, globalization. So what happens is, think about if every country had to make their own cars and all their own auto parts and their own aircraft and their own aircraft parts, it would raise prices because now you're trying to become fully or vertically integrated in every industry as opposed to being geographically diverse. When that happens, that is going to raise prices and create inefficiencies. And it's going to take a long time for the global economy to adapt to that. And what that means is you've seen prices rise a lot in the last year. We're It means we're probably not going back to that lower level of prices. It means we're on a permanently higher plane, even if prices stop going up from today. So let's say prices today are the same in 6 months. That means you've had zero inflation, even though they're up a lot from a year ago. Okay, when we measure inflation, we are measuring the most recent data point. That's what we're measuring. Okay, so if prices stay the same for a year, and if they're up 100% the year before, we don't average it out and say 50% in the last 2 years. We just say inflation was zero for a year, but we're on a permanently higher plane of inflation. And I think that's the biggest thing that investors have to get used to. And I think that'll have a massive impact on financial planning and our ability to plan and forecast people's retirement savings and things like that. Okay. So, having said that, I want to show you a quick chart because I don't want you to. Here's the most important point I want to make. Okay. By the way, Jesse's out there. Hi, Daddy. I love you from Jesse, Brandon, Benji, Oliver, and Calvin. Love you too. Okay. That's cute. But let's go on. What I really want to point out is this. When you hear about all of these things, globalization uh, on the wane, inverted yield curve, inflation, interest rates going up, the Federal Reserve is being hawkish, this is enough to scare you. Okay. This is enough to scare a lot of people out of the market. And I don't want that to happen to you. I don't want you to be scared, out of the stock market because you still have your long-term goals to fund. You have your future to fund. These are important things. And since I've been in the business since over 30 years, since 1990, there has always been something else to worry about. There's always some pundit on TV who says, you know, there's always some pundit on TV who says, we're not out of the woods yet. We still have this, and that to worry about. These things have not been completely resolved, so they could still be a problem. Yeah, there's always something that could still be a problem. Does that mean are they trying to tell you, well, we're not out of the woods, so don't invest yet? Or there could be another, minor tremor from whatever was happening. So sell everything and wait till the tremor is past and they get back into the market. I that's what is that what pundits do? Apparently it is. Don't change. If you have a strategy and you have your portfolio set up the way it should be to help you attain your long-term goals. Don't let all of these things frighten you out of the stock market. That's not what should happen. It's expected that you will have frightening things that happen in the world that will have a very negative impact on the stock market over the near term, which typically the stock market will then recover over the midterm. And when has the stock market not recovered from a bear market? Not every recession in the economy is a death knell for the stock market. The stock market usually does go down. It almost always goes down in a recession, but it doesn't always go down a lot. And the fact is, there was a study done. I'm going to just show you this on, I saw this on Forbes. Let me just pull this up here. Okay. And this is, I thought this was really interesting. Okay. I read this before. I'll see if I can make this a little bit bigger because it's really good. You really should just take a look at this. Okay. It's taking up about as much of my screen as we could get here. Maybe it's a little too much. It's too much. Okay. Is that better? All right. But basically, what this is telling you is the worst part of stock market performance is not the recession. It's the 6 months or so, the 6 months to a year before a recession is when most of the damage is done. And then, okay, if you use 6 months before, and then during the recession, with the exception of 2007 to 2009 recession, that was a real hit to the market. But 2 years later, the market was up 44%. Okay. And 80% of the time, the stock market has been up in the last, in every recession since 1950. The stock market has been up 2 years later, and almost every time 1 year later. And 6 months after, it's usually recovered quite a bit. Sometimes it's down a little bit. It depends. Every situation is a little different. So having said that, we see the recoveries. And I think the big difference between going into a recession now as opposed to going into a recession 2007, 2008 is that the stock market is a forward-looking mechanism. So we factor in a recession, and then quickly we factor in the recovery. And as people start to realize that, the market's down, but it recovers, I think that could actually even smooth out the vagaries of the stock market, the stock market reaction to volatility. The last big recession we had only lasted 2 months. It was a hell of a doozy. That was in 2020 when the U.S. economy shut down, and it caused the stock market to go down almost 40% in a matter of about 6 weeks or so, which was a record time for the market to drop that much. Do we have that again? The market turned out to do really well at that point. So if you sold in 2020 and said, I have to get out, there's a global pandemic, you missed out on the one place in your whole life where you could have really accumulated a lot of wealth. You may have lost your job, your income may have been impacted, but the stock market was the one place where you could have really, really done incredibly well. So keep the faith. Don't let this stuff scare you, and don't let this, we're not out of the woods yet. We could see another rocky market. We have to wait for the Fed minutes. We have to see if the Fed raises 0.5% at their next meeting and the meeting after that. Folks, there's always going to be another boogeyman around the next corner. And then we get through it. Don't let this stuff scare you out of what should be a solid long-term strategy for yourself. All right. That's my story. I'm sticking to it. I'll be back tomorrow with more. And thank you so much for joining me.